Have you ever wondered why some investors are more successful than others? Could the secret to investment success lie in the type of investor you are? In the world of investing, there are various types of investors. Let's dive into each of these types, comparing and contrasting their characteristics and strategies. At one end of the spectrum, there are retail investors. These are everyday individuals who buy stocks or bonds directly from broker-dealers. Often these investors have limited assets and income and may hold assets in a single account or jointly with a spouse or friend. Other forms of retail ownership include retirement accounts or custodial accounts for children. The primary focus of securities regulation is on protecting these retail investors. On the other end of the spectrum, we have accredited investors. These are individuals or entities who, by the nature of their income or assets, are viewed as more sophisticated and able to assume greater risk. This group includes financial institutions, large tax-exempt pension plans, private business development companies, and individuals with a net worth of at least $1 million or a gross annual income of at least $200,000. Then there are institutional investors. These are typically large entities that pool their money to purchase securities. They include banks, insurance companies, pension plans, endowments, and hedge funds. To be considered a qualified institutional buyer, an entity must meet a three-part test. 1. It must be a certain type of investor, such as insurance companies, certain bank trust funds, business trusts, registered investment companies, small business development companies, registered investment advisors, private and public pension plans, partnerships, and certain non-profit organizations. 2. Purchasing for its own account. And 3. Must own and invest at least $100 million of securities. It's important to note that an individual, even one who meets the standard of being an accredited individual investor, is not considered to be a qualified institutional buyer. These are not humans. They're entities such as firms. So, to summarize, there are three main types of investors: retail investors, accredited investors, and institutional investors. Retail investors are regular individuals with limited assets and income. Accredited investors are those with high income or net worth and are considered more sophisticated. Institutional investors are large entities that pool their money to purchase securities. Each of these types of investors has its own strategies, advantages, and disadvantages. Understanding these distinctions can help you identify what type of investor you are and what strategies might be best for your investment journey. Remember, investment success doesn't happen overnight. It requires knowledge, patience, and strategic planning. So keep learning and keep investing. Until next time, keep those portfolios growing.